Hello everyone, and welcome to today's lecture. Our focus today is on one of the most essential trading concepts, the market order. Whether you are a beginner investor or a seasoned trader, understanding market orders is fundamental to navigating the financial markets. By the end of this session, you will know what a market order is, how it works, and when to use it. A market order is an instruction you give to your broker or trading platform to buy or sell a security immediately at the best available current price. The priority of a market order is execution speed, not price. It guarantees that the trade will happen, but the final price may differ slightly from the quote you saw when you placed the order. In short, a market order guarantees execution but not price, which makes it very different from a limit order, which guarantees price but not execution. Here are the main characteristics of market orders. First, speed of execution. Market orders are filled as quickly as possible. They are ideal for traders who need to enter or exit a position immediately. Second, price uncertainty. Because the market can move quickly, the exact execution price may be slightly different from what you expected. This difference is called slippage. Third, liquidity dependent. Market orders work best in highly liquid markets like large cap stocks or major currencies. In illiquid markets, the impact on price can be significant. Fourth, no price limit. Unlike limit orders, you do not set a maximum price for a buy or a minimum price for a sell. You are agreeing to take the best available price. Let's look at two examples to make this clear. Suppose you decide to buy 100 shares of Apple. The current quote is $180 bid and $180.10 ask. You place a market buy order. Your order is filled instantly, most likely at $180.10. The best available asking price. Now imagine you want to sell 50 shares of Tesla. The current quote is $250 bid and $250.50 ask. Your market sell order executes immediately at $250, the best available bid price. There are several reasons traders use market orders. Certainty of execution. The trade will be completed. No waiting around for a certain price level. Simplicity. Market orders are the most straightforward type of order, making them beginner-friendly. Speed. Perfect when entering or exiting a position quickly is more important than the price you get. Market orders also have some drawbacks to consider. Price slippage. In fast-moving markets, you may end up paying more or receiving less than expected. Not ideal for illiquid assets. If the order book is thin, your order may get filled at much worse prices as it walks the book. No price control. You cannot specify a limit to protect against unfavorable prices. In summary, a market order is a go-to choice when execution speed is your priority. It is simple, fast, and ensures that your trade will happen, but it comes at the cost of price certainty. For highly liquid markets, this is often acceptable, but in volatile or illiquid markets, the lack of price control can lead to unexpected outcomes. This concludes our discussion about market order. See you at the next lecture.